afternoon. My name is Kent Scornia, President and CEO of Krilogy, and I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy. Welcome, Johnny.
Good to be here.
January market perspective, here we go.
Yeah, time's
2024. Can you believe it?
It's incredible.
Incredible. Fast month. Market's on fire. Almost hard to believe it's at this sort of pace already for the year. Ever since that October low, it's just been really off to the races. What's your team seeing?
It's been off to the races for sure. All-time highs today yet again. Here we are at the very end of January. Big week with economic data, big cap tech earnings. It's interesting. We're at a point, we've hit all-time highs in the S&P. At a sector level, the technology index, of course, has hit all-time highs.
Yep.
Yet, if we look at the other 10 sectors, none of the others have. And in fact, on average, they're about 15% below their all-time highs. So
almost
tech
the
is
same
leading
old
the
story.
charge.
Almost the same old. Yeah. Magnificent Seven is still leading the way, right?
Very similar to the 2021 period.
Yeah.
Yeah. So, it's really time for earnings to show up and broaden out. If we look at earnings revisions going back to September, not surprisingly, we've seen almost a 15% decline in the 493 stocks that aren't the Magnificent Seven.
Yeah.
And so, since that period, we've seen earnings revisions creep up slightly, meagerly positive, and it's reflected in price. And so really, I think the question on a go forward is how much in price has been front run by what I'm sure will be great numbers this week, but is it going to be enough to sustain, which will of course impact the indices based on the, how the indexes are constructed, and the power of tech is really significant. So we really need to see this broadening out in earnings, but earnings peaked in the S&P in Q4 of 2021.
Right. That's a long time ago.
It's a long time ago. That was about, just shy of $57 a share on a quarterly basis. The S&P will probably do $53 a share this quarter. I mean, so we've seen significant multiple expansion from, call it 15 PE to over 20 on a forward PE. And that's all fine and good, but we really need to see, as we talked about in the last month or two, we need to see earnings broaden out and follow through. The challenge, though, is, we're seeing the Fed winning the war on inflation. PCE, which is their favorite inflation gauge, they're favored, I guess, inflation gauge on the last 3 and 6 month annualized is under their 2% target. On a shorter term basis. So they're winning that war. So the market is celebrating the reality that the Fed is done. It's just a question of when and how much does the cutting cycle.
Right. When does that start? How do they start? When,
Right. What
economic conditions propel them to start?
That's exactly right. And I think it's important to just be mindful of that disinflationary reality. Hurts companies at some level.
Absolutely does.
We're seeing margins start to compress from what had been pretty significant highs over the last several years. So margins are coming down in looking at Q4 and then rolling over into Q1. That's ultimately going to hurt earnings on a go forward. And that earnings bar, I mean, let's face it, it's high. It's high.
Yeah.
So
the Fed is what everyone continues to speak. Have they threaded the needle here?
Yeah.
And created this soft landing after such harsh economic conditions they require. They put on us with the high interest rates.
It's interesting. I mean, probability would say that it's very much still in the realm of recessionary conditions happening.
Even though when you look at the markets,
I know it
doesn't feel that way. And the market and the economy are they're different animals.
They're different animals,
related but different animals.
And it's classic. If you look at any pre-recessionary periods historically, from a financial media perspective, there's all this talk of soft landing prior.
Right.
And I mean, it's historic.
The old this time is different, right?
It's this, yeah, exactly. And so, in the 14, going back to the 1950s, the 14 hiking cycles, 11 of them resulted in a recession. So if we recognize that, and then recognize the fact that this is the most upward sloping rate hiking cycle that we've ever seen at 500 plus basis points in short order, the probabilities aren't great And, if we also realize that from start of first hike until recession starts, again, going back to the 50s on average, that's a 26-month period. We're at 23. So obviously the visibility around the when is really challenging. I think if we step back from the noise, I think it's really important to recognize that overall global liquidity has had a significant influence. There's some really great charts by Cross-Border Capital and Goldman Sachs Financial Condition Index, and they're overlaid with one another. And these liquidity cycles tend to work in 4 and 5 year periods. And liquidity bottomed, not surprisingly, around the October lows. And going back to 2022, and we've kind of seen this upward sloping move in financial conditions and liquidity overall. And as crazy as it sounds, there's nothing that prevents this liquidity and recession can being kicked into 2025 or beyond. It's just really hard to quantify the influence of those conditions.
Yeah. Well, you and I sound very depressed today, don't we? But the market climbs this wall of worry, right?
Yeah.
Always. I think that's important to understand. But also, there's an air pocket here potentially,
for sure,
with these with the market sort of driving up as quickly as it has since October.
Yeah.
It is going to peel back at some point. Is it a 3% peel back? Is it a 7? Is it a 10 in a correction range?
Yeah.
It's really hard to say, but what do you do when you're managing a portfolio?
That's a great point. And to just highlight on that, then I'll answer that question. It would be very, very normal at this point of this move, particularly in election year and Q1, which tends to be softer, given the magnitude of the move that we've seen, to see a 5 to 10% corrective move in the context of a growth scare, an economic growth scare. And, if we look at this month, the 5 regional Fed manufacturing surveys were incredibly weak. So you've got New York, Philly, Kansas City, Richmond, and Dallas, excuse me. And so you've got these 5 regional Fed surveys. They had their worst miss relative to expectations in going back to 2011, other than March of 2020 and December of 18.
Wow.
So, all of a sudden, there can be these cracks mounting underneath the surface. You marry that with increasing unemployment. The tech sector alone had 25,000 jobs layoffs in January alone,
right?
In just the
big
tech
numbers.
sector. We see all these, anecdotal economic type indicators under the surface. And again, they can manifest quickly but yet could take some time. So I would say that, a growth scare would be really reasonable to assume at some point, which could result in a 5 to 10% corrective move. Will that catalyst be the Fed tomorrow? Will it be earnings after the bell these next couple days? I don't know, but that would be normal.
Makes for great news. And then it also makes for the moment of real flight to quality. I mean, even if you look at globally, the U.S. economy and the U.S. market is the strongest.
Absolutely
in
right.
the entire world.
Absolutely right.
China's struggling, Europe's struggling, emerging markets are struggling.
Without a doubt.
There are, that flight quality is a really big moment right now.
You're right. I think it's a function of, a lot of the fixed rate debt that our economy in general has taken advantage of during, the COVID period when rates were as low as they were. The innovation and the advance of technology is absolutely a factor in helping weather that storm. But you're right. The U.S. is relative to other segments has continued to just,
continue to pop along,
really surge.
So, getting back to the portfolios now.
Yeah.
So,
never answer.
Yes, that's okay. We, what's your team seeing?
Yeah.
What are the things we worry about? What are the things we're excited about?
Yeah. We're focusing on quality. It's a theme we've mentioned, over the past few months within the equity segments of the portfolio. Of course, you need to balance that, that quality exposure with other market capitalizations that look disconnected from what we feel is a longer term normal reality, such as small cap exposure of the quality elk. As Jake Thornton on our team always, likes to talk about, the starting point is critical. What you're paying now for free cash flow is is absolutely important. And if so, we look at
particularly when interest rates are at 4 or 5.
Absolutely.
When you're getting 4 or 5 points, free money.
That's right.
Risk-free returns.
You're absolutely right. You start to look at, cyclically adjusted PE ratios, and you're in the low 30s, from a historical perspective, whether you're looking at 5-year or 10-year forward returns, it is not good for equities.
Right.
And, it could get much more silly before, any type of reckoning, but broadly speaking, deploying new capital here into equities is more of a cautious measure, I think, just based on valuations and kind of.
If we go back 24 months and, Fed funds rate was at 1, less than 1, you had no choice to get return other than move money to risk your assets.
Absolutely.
Today you have a choice.
Absolutely.
And it's a difficult choice sometimes.
It is a difficult choice. And, I just had spent some time with PIMCO, who had, just incredible insights around, some dislocations in the bond market and how, at peak rate levels and when the Fed starts to cut, the opportunity that exists for the fixed income space broadly. And that's everything from, agency mortgage-backed securities to non-agencies to, core U.S. bonds. I mean, the list goes on and on in terms of the opportunity. But if we look at the bond market space and can recognize that, mid to upper single digit returns are possible for segments of fixed income looking out a number of years. I mean, those are equity-like returns over long 75 plus year cycles. And so, really recognizing that proper balance in equity and fixed income in a portfolio is critical here, particularly if we, again, not consensus, but if we result in a hard landing from an economic perspective, a recessionary condition. I mean,
or even a less soft or firm landing versus the hard.
That's exactly right. Yeah,
but there's opportunities there. I think you made this we had this conversation August, September, and we started to go a little bit longer in the duration of our bond portfolio. Mm-hmm. If interest rates continue to drop, and they are,
that's right.
Huge opportunity on the upside there.
That's right. Yeah, there's been a lot of discussion around the market expecting, up to 200 basis points in cuts. And actually, it's not historically wrong for the market to be thinking that. I mean, candidly, that's the aggressiveness around rate cutting once it begins is very much on par with expectations. I think the disconnect in this environment is the Fed's projections and kind of the when around that begins to happen. Now, it's interesting in that it's an election year, and, you could argue...
will the Fed have the courage to...
Well, you could argue they may want to kind of front load that process.
Right.
And, March right now is less than 50% odds of a cut, but doing that in advance of, on the heels of an election may be the path. Again, given the evidence of the inflationary battle, while it's not won, they're winning, and maybe that gives them enough to begin that process. It's hard to say.
Yeah, but it's fun to watch, isn't it?
It's entertaining, for sure.
For sure. Anything else out there we need to be aware of before we sign off?
I just think that, in looking at portfolio construction, we've talked a little bit about fixed income and opportunities there. The quality focus in equities, recognition that the quality factor, when you're comparing other equity factors such as size and momentum and value, the quality factor has been one, in the final third of an expansion and even in the first third of a recession has outperformed. And so continued emphasis around that quality factor, I think, is prudent. And then lastly, again, if you can have a decent visibility around expected returns from less to non-correlated exposures outside of pure equity and fixed income, it's certainly worth a look. It's not all created equal, but some of those exposures can really make a great deal of sense.
Especially when the markets get volatile.
That's right.
Yeah. Great. Thank you, Johnny. I appreciate your time. And thank you for the opportunities to be stewards of your wealth. For Johnny MacArthur, I'm Kent Scornia. We appreciate your time. Have a wonderful day.